Good afternoon, everyone. Welcome to this webinar organized by the Belgian Foreign Trade Agency, its partner, the FPS Foreign Affairs, Flanders Investment and Trade, AWEX, and Hub Brussels. It takes place on the occasion of the release of our two yearly publications, Belgian Trade in 2021 and World Trade 2021. We have a charged agenda for the coming hour, but allow me to just quickly run through a few frequently asked questions. First of all, the slides of the speakers will be made available. You will receive them via email and find them on our website together with the two studies. This webinar is recorded and will be uploaded on our website as well. Also, the two publications, Belgian Trade and World Trade, will be released immediately following the webinar. This webinar will end with a Q&A. In case you have a question for the speaker, you can put it in the Q&A together with the name of the speaker you address it to. In case your question won't be covered during the webinar itself, we certainly answer you at a later stage. To kick off the webinar, I have the pleasure to welcome my colleague, Dennis Gijsbrechts, International Trade Analyst at the Belgian Foreign Trade Agency, and who was in charge of the two publications. He goes through the main findings of Belgian merchandising trades in 2021. Dennis, the floor is yours.
Thank you, Christelle. 2020 was still a particularly gloomy year for Belgian international trades. 2021 was an absolute record year. During this presentation, we are going to look at the commodities that were responsible for the resurgence of Belgian exports and imports, and with which partners our country's trade in goods has increased the most. Belgian foreign trade experienced an unprecedented recovery in 2021, with Belgian exports and imports of goods increasing by 25.6% and 29.2% respectively, after falling by 7.4% and 9.1% a year earlier in the wake of the COVID-19 pandemic. Price increases for certain commodities, such as mineral products and base metals, contributed to the higher value for both exports and imports. In the first 3 months of 2020, the impact of COVID-19 on Belgian foreign trade was still relatively limited, which explains why, in the same period of 2021, exports and imports increased by just 1.3% and 2.5% respectively. However, exports and imports largely exceeded those of the previous year in the subsequent quarters of 2021, which is why, in the end, they amounted to 464.3 billion euros and 450.0 billion euros respectively. 2/3 of the growth in 2021 came from trade with EU countries and half of it from trade with our three main partners, being Germany, the Netherlands, and France. In recent months, the Russian invasion of Ukraine has put even more pressure on the already surging commodity prices. However, the effects of the war in Ukraine on foreign trade only started to become apparent in the data for March 2022. On the following slide, we see the evolution of EU exports, and total exports of goods from the European Union as a whole amounted to 5,611.6 billion euros in 2021. Belgium accounted for 8.3% of these, making it the 5th largest exporter of goods in the EU. Germany remained the undisputed leader with a share of 24.6% and exports in the amount of 1,380.1 billion euros, ahead of the Netherlands and Italy. From a percentage viewpoint, Belgian exports increased more than the EU average, and therefore Belgium's share of EU exports increased in 2021. Compared with other export-driven countries, Belgium's exports grew faster in percentage terms than those of Germany, the Netherlands, Italy, France, and Spain. The evolution of Belgian exports is also positive when compared to Austria, Ireland, Sweden, and Denmark, which are EU countries with a comparable export structure. The next slide shows the main destinations for Belgian exports of vaccines against SARS-related coronaviruses. We already mentioned that price increases for commodities such as mineral fuels And metals contributed to the higher value for exports and imports in 2021, but COVID-19 vaccines were also part of the reason for the rise in exports. Pfizer's Pure site is a major producer of this type of vaccine. Total Belgian exports of vaccines against SARS-related coronaviruses amounted to 27.2 billion euros this past year, with Germany being our country's largest client for this particular product with a share of 28.1%. Japan and the United Kingdom took second and third place. On the subsequent slide, we are given the evolution of EU imports. The 27 countries of the European Union jointly imported goods totaling 5,494 billion euros in 2021, with Belgium accounting for an 8.2% share, making it the fifth largest importer of goods in the EU. Much like for exports, Germany retained the top spot for imports with a share of 21.9% and an amount of 1,201.7 billion euros. The Netherlands and France occupied second and third place in this ranking. The combined imports of the 27 EU countries grew less than Belgium's in percentage terms, and therefore Belgium's share of total EU imports increased over the past year. Belgian imports of goods rose more sharply in percentage terms than those of other export-driven economies like Germany, the Netherlands, France, Italy, and Spain. And they also increased more than those of Austria, Sweden, Denmark, and Ireland, which are, as mentioned before, EU countries with a comparable export structure. The next slide shows the importance of the different continents in Belgian exports of goods, with Europe remaining by far the most important export market for a country in 2021, accounting for just over 3/4 of Belgian sales abroad. The 71.5 billion euro rise in exports to other European countries resulted in large part from increased exports to our directly neighboring countries. Exports of goods to Germany, France, and the Netherlands, which accounted for 45.2% of total Belgian exports in 2021, rose altogether by 51.7 billion euros. Outside Europe, trade relations with other continents have changed somewhat over the past year, with Asia once again being the main destination for Belgian goods outside Europe in 2021, after losing this position to the Americas a year earlier. Africa's share of Belgian exports amounted to 3.5%, mainly thanks to increased exports to Nigeria and Egypt. Finally, the increase in exports to Australia was the main reason for the overall growth in exports to Oceania. On the following slide, we have an overview of Belgium's 15 main clients of goods in 2021. And from this table, we can see that exports to our immediately neighboring countries saw the biggest hike in 2021. Thanks in part to the production of vaccines against SARS-related coronaviruses, exports to Germany rose by 22.0 billion euros. In addition, exports to France and the Netherlands increased by 15.8 billion euros and 13.9 billion euros respectively, due in part to the higher price for natural gas. The three aforementioned countries have thus shored up their position as Belgium's main clients. In percentage terms, however, it was exports to Japan that registered the largest increase. Exports to this country grew by 137%, or almost 4.4 billion euros, mainly thanks to the previously shown deliveries of vaccines against SARS-related coronaviruses. Then, since the United Kingdom declared that it would leave the European Union way back in 2016, Belgian exports to that country have declined each and every year. This was also the case in 2021, when exports to the United Kingdom fell by 7.1%, due in part to a decline in exports of transport equipment. Apart from the United Kingdom, China was the only other country in the top 15 of our most important clients, where Belgian goods recorded a decrease in exports in 2021. Total Belgian exports to this particular country slid by 521.6 million euros, due in part to lower transactions involving non-COVID-19 vaccines for human medicine and unrefined copper. The next slide shows Belgium's main export commodities in 2021. And with a share of 29.4% and 136.7 billion euros, chemical products still held the top position among Belgian goods exports in 2021. Last year, the main destinations for Belgian chemical and pharmaceutical exports were Germany, France, the United States, and the Netherlands. Belgian exports of mineral products, which amounted to 45.8 billion euros in 2021, were mainly to countries such as the Netherlands, France, Germany, the United Kingdom, and Nigeria. Machinery and equipment took third place in the ranking of Belgian goods exports in 2021 with a share of 9.7%. Exports of transport equipment to countries such as Germany, France, the Netherlands, Sweden, United Kingdom, and Poland contributed to the total amount of 45.0 billion euros in exports for this section, corresponding to a share of 9.7%. The plastics category completed the top 5 of Belgium's exports of goods with a share of 8.1%. The subsequent slide shows the evolution in Belgium's main export commodities, and the 33.1% growth in Belgian exports of chemical products was mainly due to the exports of vaccines against SARS-related coronaviruses. Then, since the second half of 2021, global energy prices have risen sharply. And although the context of the post-COVID-19 economic recovery and the easing of travel restrictions already suggested such an increase, it was still more pronounced than expected. The growth of 90.8% in exports of mineral products, of which energy is a part of, is explained, among other things, by the increase in value of natural gas, light oils, medium oils, and also electrical energy. The automotive industry, for its part, has also suffered various setbacks in recent years. First, there was the COVID-19 pandemic that caused the temporary closure of car factories, and this was subsequently followed by a shortage of computer chips, a problem that still continues to this day. As a result, the automotive sector has not really been able to benefit from the recovery in international trade, and as such, Belgian exports of transport equipment only grew by a modest 1.1% in 2021. That closes the parts of Belgium. That closes the export part of Belgium's foreign trade. The next slide displays the importance of the different continents in Belgian imports of goods. And the other continents on the European continent remained our main suppliers of goods in 2021, accounting for just under 3/4 of total Belgian imports. Imports from these countries increased by 79.6 billion euros in 2021, mainly due to imports from countries directly neighboring Belgium. Imports of goods from the Netherlands, Germany, and France, which accounted for 42.3% of total Belgian imports in 2021, rose together by just under 50 billion euros. Last year, Asia remained Belgium's main trading partner outside Europe for the import of goods with a share of 14.9%. Meanwhile, Belgian imports from the Americas rose by 15.9% due to higher imports from the United States and Mexico. The 15% increase in Belgian imports from Africa is partly attributable to our country's imports from South Africa. This rise enabled our imports from the entire African continent to reach a total of 10.4 billion euros in 2021. Finally, Oceania accounted for only 0.3% of goods imported by Belgium in 2021, with our purchases there rising mainly through the increase in deliveries from Australia. On the following slide, we see Belgium's 15 main suppliers of goods in 2021. And that year, the Netherlands, Germany, and France remained the 3 main suppliers of goods to our country, while the largest declines in Belgian imports were recorded with these 3 countries in 2020. They also notched up the largest increases in 2021. And the higher demand for crude petroleum oils, natural gas, and to a lesser extent, light oils, medium oils, and also biodiesel was responsible for the 44.1% growth in Belgian imports from the Netherlands last year. Besides that, the purchases of nucleic acids contributed to the increase in imports from Germany by 36.6%, while the 20% growth in imports from France was mainly because of the natural gas, hybrid vehicles, and electrical energy subsections. In 2021, the United States was still the main supplier of goods to Belgium outside the EU, with an amount of 27.8 billion euros and a share of 6.2%. Belgian imports from that country increased by 14.3% because of the growth in purchases of medicines, electrical vehicles, immunological products, and vaccines for human medicine. The largest value increase in Belgian imports from outside the EU, however, was recorded in China. Strong growth in purchases of electrical vehicles prompted an increase of 35.8% in total Belgian imports from that country last year. Also remarkable is the fact that increased demand for natural gas and higher prices for this type of commodity triggered a 212.7% or 4.9 billion euro rise in Belgian imports from Norway. Japan was the only country in Belgium's top 15 goods suppliers from whom imports fell last year. A cutback in imports of traditional cars on fossil fuels, as well as hybrid cars, led to an overall decline of 3.0% in imports from this country. We also briefly have to discuss Russia's invasion of Ukraine, and particularly the impact that the subsequent economic sanctions may have on future imports from this country. The EU decided on the 25th of February to issue a new package of economic sanctions against Russia, and to date, 5 additional packages of sanctions have been added in response to Russia invading Ukraine. In 2021, total Belgian imports of goods from Russia amounted to just under 7.8 billion euros, or 1.7% of total Belgian imports of goods. The 6th and currently final package of sanctions included the phasing out of oil imports from Russia, with mineral fuels being the largest section of imports from Russia in 2021, amounting to more than 3.2 billion euros and a share of 41.3%, compared with around 2.8 billion euros in 2020. Over the past 10 years, the highest level of mineral fuels among Belgian imports of goods from Russia was reached in 2014, when this product group accounted for just under 6 billion euros. The diamond sector has so far remained largely unaffected by EU sanctions. They accounted for 1.8 billion euros of Belgian imports of goods from Russia in 2021, compared with 1.2 billion in 2020. In the last 10 years, there have never been as many diamond imports from Russia as in 2017, when this product group amounted to just over 2.8 billion euros. The next slide shows Belgium's main import commodities in 2021, with chemical products once again topping Belgian imports of goods in 2021 with a share of 25.9%. Mineral products amounted to 64.5 billion euros, corresponding to a share of 14.3% of the overall total. In 2021, the Netherlands was unquestionably our main supplier of this type of goods, ahead of Norway and the United Kingdom. Machinery and equipment dropped to 3rd place in the ranking in 2021 and accounted for a 12.4% share of total Belgian imports of goods. With a total of 46.7 billion euros, transport equipment represented a share of 10.4% in total Belgian imports, and base metals completed the top 5 categories of Belgium's imports with a share of 7.4%. On the following slide, we see the variation in Belgium's main import commodities, and the overall increase of 36.9% in imports of chemical products is principally explained by the subcategories nucleic acids and biodiesel. Ireland, Germany, the United States, and the Netherlands were our main suppliers of chemical products last year. Then the increase in demand and the evolution of prices for natural gas, petroleum oils, light oils, and electrical energy triggered a hike of 92.8% in imports of mineral products. Then in the year under review, the shortage of computer chips had a negative effect on the production of new cars, preventing this sector from immediately benefiting from the general recovery in foreign trade, which is why purchases of transport equipment only rose by 3.4% in 2021. Last year, Germany was our country's leading supplier of transport equipment, ahead of France and Japan. The rise in iron and steel prices is partly responsible for the 44.6% increase in imports of base metals. And these came from Germany, the Netherlands, and France, among others. The final slide of my presentation shows Belgium's trade balance in goods with each continent. And because Belgium generally exports more goods than it imports, our country has a positive trade balance every year. In 2021, the general surplus amounted to 14.3 billion euros, which is roughly 7.1 billion euros less than the year before. The traditional positive balance is mainly explained by exports to other EU countries exceeding imports from those countries. And a surplus was also recorded with Africa and Oceania. The Belgian trade balance in goods with the Americas, which still displayed a surplus of 151.3 million euros in 2020, turned negative last year, which was mainly the result of the negative balances with the United States and Mexico. The trade balance with Asia also remained clearly negative. This concludes my part of the presentation. I hope it has given you some more insight into the impact of the pandemic on exports and imports of goods, and as to why trade in goods evolved in the way that it did. Thank you.
Thank you, Dennis. Thank you for presenting this main conclusion. And I will myself highlight the Belgian services trade in 2021 and Belgium's position in global trade. Now that we know which country were Belgium's main partners in merchandise trade in 2021 and which goods constitute a majority of its exports and imports, we are going to take a look at Belgium's trade in services and compare its trade performance with that of the other countries in the world. On this first slide, you see that although trading goods account for the largest share of Belgian foreign trade, transactions in services also play a significant role. Both exports and imports fell in 2020 due to the COVID-19 crisis, but recovery subsequently began in 2021, with Belgian services exports reaching 115.5 billion euro, while imports rose to 113.7 billion euro. With exports increasing slightly more in value than imports, the services balance surplus increased by 37 million euro to more than 1.8 billion euro in 2021. On the following slide, we see Belgium's main trade partners in exports of services in 2021. The Netherlands once again topped this ranking with a share of 14.8%, ahead of France and the United States. The latter was the only country in the top 10 with whom Belgium exports fell in 2021. The higher value for transportation services, communication services, and financial services couldn't compensate for the sharp decline in exports of other business services to that country. Of the 10 most important destinations for Belgian export of services, 7 also appeared in the top 10 for exports of goods, in a slightly different order. The increase of 9.1 billion euro in total Belgian export of services is partly because of the growth in sales to the Netherlands, Switzerland, and Ireland. Increased sales of other business services and to a lesser extent communication services and travel services explained growth in services exports to the Netherlands. Despite the marked increase in export of transportation services to Switzerland, that country remained in 6th place among Belgium's main trading partners. The increase in sales to Ireland is mainly attributable to other business services and to a lesser extent, communication services. Sweden was the only newcomer in the top 10 of Belgian services clients at the expense of Spain, which dropped to the 11th place. The 10 most important destinations for Belgian services export together accounted for nearly 3/4 of the total. The next slide shows the main categories in Belgian export of services in 2021. More than 1/3 of Belgian services exports were composed of what we call other business services. This section, which includes merchandising, operational leasing services, legal services, accounting, auditing, bookkeeping, and tax consultancy services, advertising, market research, and public opinion polling, and with treatment and depollution accounted for a share of 37.8%. The top three was completed by transportation services and communication services. The lockdown measures taken to contain the spread of the COVID-19 virus had a particularly serious impact on travel services and transportation services. However, in 2021, exports of the latter group of services recovered as trade and thus the transport of goods increased, resulting in a rise in exports in the transportation services section by 10.6%. Belgian export of travel services fell by another 3.3% in 2021 to just under 6.6 billion euro. As in 2020, there was a decline in the number of tourists and business travelers visiting our country. The next slide gives us an overview of Belgium's main trade partners in imports of services in 2021. The three largest suppliers of services to our country continue to be the Netherlands, France, and Germany. Of the 10 most important services supplying countries, 8 of them also appeared in the ranking for goods imports last year, in a slightly different order. The increase of almost 9.1 billion euro in total Belgian imports of services is partly attributable to higher purchase from Germany, the United States, and Switzerland. Especially the value of both other business services and transportation services increased in imports from Germany. These two groups of services also contributed to the growth of imports from Switzerland. The rise in Belgian imports from the United States was mainly due to the increase in communication services. Compared to 2020, the other countries from the top 10 also maintained their position among the main services providers to Belgium. The 10 countries in the table together accounted for more than 3/4 of total Belgian imports of services in 2021. The next slides list the main categories in Belgian imports of services in 2021. Similar to exports, Belgian imports of services consisted mainly of other businesses services. This section amounted to just over 42.8 billion euro, corresponding to a share of 37.7%. Transportation services, which include sea transport, air transport, space transport, rail transport, road transport, inland waterway transport, and pipeline transport, occupied second place. Meanwhile, communication services rounded off the top 3 import categories. As mentioned earlier, the lockdown measures taken in 2020 to contain the spread of the COVID-19 virus had a particularly severe impact on both travel services and transportation services. However, these two services groups managed to recover in 2021, which is why total Belgian imports of services exceeded their 2020 level by 8.7%. The year 2021 saw an increase in the number of Belgians traveling abroad. There was also a rise in the spending habits during their stay. This resulted in an increase of 9.1% in travel services. The increase in the transport of goods after the pandemic had an impact on imports of transportation services, which grew by 20.4% to nearly 25.6 billion euro. Now that we have given an indication on the evolution of Belgium's trade in both goods and services, we are briefly going to look at how Belgium's performance holds up when compared to the rest of the world. On the following slide, we are given an overview of the evolution of merchandise exports and imports per continent. All continents clearly displayed significantly higher values for both exports and imports of goods. After a dramatic year for the global economy, economic activity and international merchandise trade rebounded strongly in 2021. The dollar value of world merchandise exports increased to $20.28 trillion as exports grew by 26.3%. The first half of the year observed robust growth in merchandise trade, driven by the speedy progress of vaccination campaigns in the developed world, especially in the European Union and the United States. The second half of the year saw the rise of the COVID-19 Delta variant, forcing many economies, especially in East and Southeast Asia, to impose new lockdown measures, thereby once again disrupting global value chains and hampering trade growth. The recovery in global merchant trade has reflected a rotation of global demand towards highly trade-intensive manufactured goods and especially durable goods. Meanwhile, pandemic-related factory and port shutdowns, weather-induced logistics bottlenecks, and an acute shortage of semiconductors and shipping containers have put significant strains on global supply chains in 2021. The bottlenecks that have stretched through global supply chains have led to a surge in the backlog of orders for traded goods and to record high shipping prices. At the same time, inventories have been depleted by businesses seeking to meet the rebound in demand. On the subsequent slide, we are given the leading exporters of goods in the world in 2021. The top 5 of the largest exporting countries in the world was still composed of the same 5 nations as the year before. China remained the leading merchandise export with a share of 15.1% before the United States and Germany. Merchandise exports from China have soared by 29.9% in 2021, fueled by rising global demand for electrical and electronic products and medical equipment. The United States set export records with 57 trading partners in 2021, including big markets such as Mexico, China, the Republic of Korea, and Germany. This culminated in a surge of 23.1% in the value of its exports. Germany recorded an 18% rise in exports as a weak euro exchange rate and few social restrictions in the main export destination seem to have driven export growth. Meanwhile, the Netherlands and Japan completed the top 5 with shares of 3.8% and 3.4% respectively. In 2021, Belgium still occupied the same position on the list of world merchandise exporters as it did the previous years. It ranked in 10th place with a share of 2.4% before Canada, but behind France. Several reasons can explain Belgium's position among the top exporters in the world. For example, there was the economic recovery following the global pandemic, which increased both the demand for and the prices of many products. In addition, the export of COVID-19 vaccines also had a major effect on the end results. The following slide shows the leading importers of goods in the world in 2021. The United Kingdom was no longer among the 5 largest importers of goods in the world, as it fell from 4th to 8th place. Japan took over its fourth place, while the Netherlands entered the top 5. The top 3 was still unchanged when compared to a year earlier, as China remained in second place, behind the United States, but ahead of Germany. Imports in the United States were up by 22% in value, with China still being the largest supplier of goods, despite the billions of dollars of tariff the US imposed on shipments. China recorded an overall increase of 30.1% in imports, with purchases increasing across most products in the year. The rise in Chinese imports was largely due to higher imports of energy products caused by surging prices. The value of German imports of goods grew by 21.1% this past year, marking the biggest jump in imports Germany as since a 1974 oil embargo that was triggered by the Middle East conflict. Belgium was down from 12 to 13 on the list of the largest merchandise importers in the world, even though the value of our country's imports of goods was up by 28.1% last year, due in part to the general trend of rising energy prices. The next slide displays the evolution of services exports and imports per continent. The value of both exports and imports of services had grown markedly in 2021 when compared to the year before. Even though global services trade has progressively recovered from the COVID-19 crisis, the dollar value of total export of services was only at $6.02 trillion at the end of 2021, which was still 4.2% below pre-pandemic levels. However, in comparison to 2020, exports had increased by 16.7%. The reason why international trade in services experienced a more pronounced fall than merchandise trade during the first year of the pandemic had to do with the fact that the COVID-19 virus restricted cross-border mobility, which proved to be disastrous to not only tourism, but also services trade, since the latter often required physical proximity between suppliers and consumers. The subsequent vaccine rollout allowed countries to lift or reduce some international travel restrictions in 2020, contributing to the partial recovery of international travel. Yet, at the end of last year, travel services were still only at 40% of their pre-pandemic levels. In contrast to travel services, non-travel services were at a faster recovery track in 2021. Transport and other business services have followed the recovery in global goods trade, having experienced sustained growth after the slump during the initial stage of the pandemic. Services delivered online have also experienced heightened demand during these last 2 years, mostly due to the shift to working remotely and increased digitalizations. Both trends will continue to materialize, with the ICT sector expected to continue leading these expansions. On the slides, we see the list of the 5 leading services exporters in the world in 2021. There was one newcomer among the world's leading services exporters, as Ireland took over the number 5 position from the Netherlands, since exports of this latter country were only up by 10.4%, while those of Ireland grew by 20.6%. The United Kingdom remained in second place, well behind the United States. For the United States, activity in the travel and transport subcategories fell by more than 90% in the beginning of 2020 and has yet to recover fully, which is why at the end of 2021, total US services exports were still 12% below their pre-pandemic level of 2019. Exports of services from the United Kingdom grew by 8.1% in value in 2021, despite the fact that this past year the UK faced new barriers for services exports to the EU compared to the freedom it enjoyed as a single market member. Financial services, which are the country's largest single services export, have struggled to recover from the twin hits of COVID-19 and Brexit. Other sectors are facing much better. Export of other business services, which include consultancy, outsourcing, legal advice, and architecture, had almost recovered to peak levels. Meanwhile, China took over third place from Germany since exports of China recorded a growth rate which was nearly double that of Germany. Chinese exports were up 40.5% in value, with freight transport accounting for a large part of the increase. The growth in Belgian export of services remained below the worldwide average increase, which is why our country was down from 12th to 13th place on the list of main exporters of services in 2021. And the last slide, the final slide of my presentation, displays the major services importing countries in the world in 2021. The top 5 of the world's leading services importers was still composed of the same 5 nations as the year before. The United States still dominated the ranking in 2021 before China. The largest segment in the United States import of services was professional services, followed by financial services and digital and electronic services. Chinese imports were still quite a long way from the pre-COVID-19 levels of 2019 due to the weight that travel traditionally used to have in Chinese imports of services before the pandemic. However, imports of insurance and financial service, intellectual property services, and telecommunication, computer and information services all ended at significantly higher levels than in 2020. Germany and Ireland switched places, with Germany now occupying 3rd place in worldwide imports of services, ahead of Ireland. German imports of services rebounded in large part to the easing of coronavirus pandemic containment measures as of May 2021. Meanwhile, France completed the top 5 of the largest services importing countries in the world. The increase in Belgian imports of services remained below the worldwide average rise, which is why it was down to 12th place on the list of major importers of services in 2021. To end this webinar, we are very honored to welcome Mrs. Véronique Goossens, Chief Economist at Belfius. She will present the Global Outlook Belfius Strategic Research. Mrs. Goossens, the floor is yours.
Thank you very much. I would like to start with you with the surprise of the year. That's namely inflation. Inflation being a lot higher than was thought before and staying a lot longer than we could have anticipated. Now, what explains this? Mainly, it's the combination of high consumer demand for durable goods during the lockdowns. Now we're getting back 1.5 years. Then we had the global supply chains, which were severely in problems. We had soaring commodity prices. We had reopening inflation, mainly it was in services because they had to be closed for a long time. Then later came up labor market scarcity, driving wages up in the US, which feeds the core inflation in the US. And that is why inflation got so high in the US before it got there in the European Union. And that's why the Federal Reserve is already starting to make things a bit more difficult for inflation. And then what we didn't expect, of course, was the Russian invasion in Ukraine. It provoked an unknown uncertainty around energy supply and also food supply, as Ukraine and Russia are very important wheat exporters, but also exporters of fertilizer and many kinds of oils. So that's what all in a bunch is driving this inflation. And what we experience now is not less than the largest commodity shock since the 1970s. Now, if you look at the right graph, you see that some of the commodities are getting down or calming down already, like steel, it's copper, it's aluminium, but others like energy prices and food prices are really soaring and will stay high this year, and we expect them to stay high for next year too. Energy prices are expected to stay elevated as well. Now, what you see here is the price that we are paying today in the red line and the rose line. These are the futures. That means that is what markets tell us about their expectations of energy prices. Now, I can tell you in the last months, if you would go to future prices, every time future prices would go up for this year, for the next year. So these might change again in a few weeks. Now, what we could say about gas is that in our projections, we assume that Russia will not cut its gas exports completely, but a complete halt to Russian gas looks increasingly likely if you follow the news of the last days. Now, this would mean industry rationing in Germany, and that would mean reducing activity or even shutting down completely. And that would be, of course, in the most energy intensive companies like where they make chemicals, base metals, and this would have really knock-on effects in the rest of the supply chain. It's really very difficult to assess these effects, but there will be effects that will be for certain. It's not our base case that this is likely to happen, but it's something we should be paying attention to. Now, what we experience here in the European Union is that we'll see core inflation going up in the coming months and the coming year, because not all the producer prices are priced in for consumers. That's what you can see in the graph underneath. If you see at the business survey of May, and we see that selling price expectations rose to a new all-time high in retail trade. And for the other sectors, we see industries, construction, and services, we see a little bit of a coming down. But what is, of course, fueling this selling price expectations is the graph on top, where you see that wage growth is already happening because of increases in minimum wages. And also we see that because of the tight labor market, pressure on wage growth is already happening. And the ECB thinks that in the next year, the wages are growing nominally with more than 4%, and this year with more than 40%, and more than 4% also in the next year. And this will fuel in, of course, into core inflation. However, inflation is to come down next year. That is what most economists expect. It's what the ECB expect. It's what most institutions like OECD, IMF expect for next year. Now, how is this going to happen? What we see here, and you have the vertical line, that's the line we have today. It's and every line on this graph is a month in a year. So we're in the middle of 2022, and there you can see that services inflation is quite high, but also the effect of energy prices is really high in this overall inflation, and which is hardly to combat by the ECB nor the higher food prices. And you see that energy prices are staying quite quite high for the rest of the year. Also food prices, and these will continue also next year. But what will happen next year if we make the assumption that indeed, like what futures tell us, that energy prices won't be as high as in the beginning of this year, because what is the thing with inflation? They always compare inflation, let us say February and March next year with February, March of this year. And we know that we experienced in that period a surge in energy prices because of the start of the war in Ukraine. And next year, that kind of base effect will disappear. That doesn't mean that energy prices won't stay elevated. They will, alone they will not get any higher. That's what is happening right now in this graph. What you see is also the fact that core inflation, and I mean the non-industrial goods, services, household goods, that it will stay quite elevated, almost 4%, 4% in 2023. And it will get a bit of a negative effect if we assume that energy prices won't get up anymore next year. So that's why inflation gradually will come down, although core inflation will stay high, because at one point, of course, all producers will, all retailers, all providers of services will price these higher commodity prices, the higher energy prices and the higher wages into their products to consumers. Okay, now one of the words you hear very often the last weeks, the last days is recession. There is fear of recession. Now, we in our base case, we do not assume a recession, but it's clear that the downside risks are really mounting. Now, why do we say that? That our base case is that we do not assume a recession. There are still good signs in a world economy. For instance, world trade is still higher than it was before COVID-19. That's for one thing. And we see that manufacturing activity will keep growing if you believe the confidence indicators of manufacturing businesses. And at least we can say that about the US and about the Eurozone. Now, okay, they're coming down, but they're still quite positive, which means the confidence indicators indicate that if you're above 50, then there's growth. If you're underneath, businesses expect that expansion's over and that activity will slow down. So there is indeed a slowdown in confidence, but expectations still point to expansion. And in China, we have a completely different situation, where we saw that the zero COVID policy was very, very severe in the first months of this year. And it's only a few weeks that things are getting better there. And that is why we see contraction in the manufacturing sector. But the last figure shows that confidence is getting better. And that's also fueled by a very ambitious program that has been announced by Chinese government. It announced 33 measures intensifying efforts to boost economic growth. They want to support businesses, they want to support investment, consumption, food and energy security, and supply chain stabilization is also in those 33 measures. So it might be the case that in the coming months, in the second half of the year, that China and emerging markets, and they all stick together, you know, are taking a lead in the recovery of the second half of this year, thanks to fiscal and monetary measures. And we see that resilience of emerging markets in general is really in relative good shape after COVID-19. we do not assume a recession, but downside risks are mounting. Now, if you look at delivery times, these are getting better. We're coming out of a very severe period of supply chain constraints. And we can see now that things are getting better, but of course we are not seeing the situation as it was before COVID-19. Still, shipping costs are falling, but they're still really expensive. So it's a little bit early to celebrate this because there's still congestion all around the world. And supply chain disruptions might hold on till the end of 2023, but things are getting better gradually, and this is good for the manufacturing industry. Now, if you look at the services, services are in the situation of COVID restriction being gone after a few months, and there was reopening, there was good activity in this sector. But of course, because of the inflation figures, because of the war in Ukraine, and because of real wages getting a bit lower because of this high inflation, services are not so optimistic about the months to come, or less enthusiastic about it. But anyway, they count on growth, expansion. So that's a good sign, even if it is decelerating this confidence. The same thing here we see in China, which is perfectly normal. We see that the Chinese consumer is not in a good shape at this moment. They are experiencing a great crisis in the housing market that was prompted by Evergrande last year, and it's still going on. So when there is a housing crisis, the Chinese consumers don't feel as rich and they don't want to spend. At the same time, with all these lockdowns we experienced in the last months, we have seen that there was a loss in new businesses, was a loss in consumer confidence. There had been many effects on consumers, like unemployment, and this all weighs on the services sector. But the recent signs show that we are getting there in a better mood. Now, if we would go to the Eurozone and see at labor market, we have another argument to say, well, things are not that bad as it looks at the moment. We have a historical low unemployment, and historical low unemployment in the Eurozone, and businesses are telling us we will be hiring in the months to come and even in the years to come. So we expect unemployment to drop a bit more in the years to come. And demand for labor is even stronger than pre-COVID due to higher public employment. So we see that support from governments is still in place. And what is also an advantage in the European economy is that the disposable income is higher than pre-COVID, because companies intend to continue hiring public services as well. And that means on a macroeconomic level that disposable income is going to grow in the years to come, which is good for consumption. Because it won't be coming from these excess savings. You remember that there were a lot of savings during the pandemic, but a lot of these excess savings have been gone already. So that will not be the part to support consumption in the months and years to come. Now, if we would compare this to the labor market, in the US, there we see even a better unemployment rate. And it is clear that the companies in the US are having it more easier to find people these days, before there was a real problem because all workers that got licensed, got sacked during the pandemic, they didn't come back to the labor market, but very gradually they came back, and we see now that, well, we could say that this is full employment, and it's the reason, and it's a good reason, it's the reason that the Fed should really be tightening conditions in the financial markets to make sure that overheating, which is already happening, is not going to destroy American economy like it did in the 70s and the 80s. So this is very important, these things to be restored right now. And these restrictive central bank policy and tightening will weigh on consumer demand. You already see that consumer confidence is going down, and these will guide to higher unemployment rate later this year, which will not say that the unemployment rate will be really high. That's not what I'm saying, but we will see a softening of economic growth. That's really likely. Now, the ECB is only starting now in July, namely to its tightening policy. And what we expect is that in the coming months, they will raise 25 basis points in their deposit rate in July, and 25 or maybe even 50 basis points in September. That really depends on new inflation figures. That really depends on the energy supply situation and the situation also in Germany. Now, what market is thinking right now is that a bit less than 175 basis points will be the increase of the ECB deposit rate by the end of this year, which is a game changer enormously about what we have experienced in the last almost 10 years. Now, what is really worrying in the European Union, the Eurozone, is that central bank, of course, wants to tame inflation. You know, that they can't tame the energy inflation, they can't tame food inflation, but they can tame core inflation, the products we buy, the services we buy. And we see that core inflation will get up in the months to come and in the year to come. So they have to fight it. But at the same time, we see that the peripheral countries like Italy, they experience higher spreads. So that means that borrowing costs for these countries are getting much more expensive, which is, of course, not an easy thing to deal with, as, for instance, an Italian government. And if spreads would go too wide, that's not a situation you want to have, because it would be a repetition of the situation we experienced here in Europe, the debt crisis in 2011, 2012. So that's not what we want to have either. So it will be a very, very difficult path for the ECB to do the things in the right manner. And right now it is working on a spread fighting tool, anti-fragmentation tool, as they call it, to be installed, because of course, just until now, they tried to limit the nominal long-term rates. But of course, if their asset purchase program comes to an end, then it will be much more difficult to tackle spreads widening. Now, the Fed is more decisive to tame inflation. If you look at the median expectations for 2022, you see that we will have a federal funds rate of 375, which is actually also a game changer, since we experienced very low also in the United States, but not so long as we experienced in the Eurozone. But there we have another risk, and that's maybe if we see that inflation gets higher. And the thing is, if inflation is getting higher, the last month we experienced that again, then it might be a brutal action that Federal Reserve will be taken, and a faster than anticipated rate tightening, and that might jeopardize a soft landing. And that's the reason why everybody, at least in the United States, is talking about recession, fearing about recession. So that needs to be materialized, of course. And we'll see about inflation figures in the months to come. Now, I would like to say just a little word about Belgium, because here we have a very particular and remarkable situation, because here we experience the automatic wage indexation. And what we see is that wage indexation, well, that wage growth is a lot higher than in the rest of Europe, and that exporters, what we have been hearing about in the last hour, they are losing competitiveness. And if we don't monitor this really good, we might end up, if this goes on for long, in a situation where we landed at the end of the 70s. And I took here a graph which I found in the year report of the National Bank of Belgium, where you can see that consumers during that period were strongly protected by automatic wage indexation. The companies, they really had a hard time. And of course, the economics were completely different at that time. So, I mean, there was not such globalization as we experience today. A Belgian economy was still very deeply into steel, textile. We were not really producing things that the world was asking for. But anyway, companies really had a hard time and disappeared, or they got subsidized to keep afloat. And well, we had shutdowns, restructurations, and of course, the government had to come with compensations for everybody who lost their jobs. And we got in this situation where Belgium was called the sick man of Europe at the end of the 70s, and we even needed a devaluation to get things done in the later 80s, in the years 82, and some other measures, some harsh measures, I would say, in the years that followed this devaluation. We don't want this again, so we have to monitor this really closely. So at last, I come to our projections. What we see here is still growth for the Belgian economy above trend this year. You have to know that there's a mathematical effect playing here. Actually, the real growth we experience this year will be very low. It's because we had such well, a great growth last year that we have a big mathematical effect on this figure of 2.2% real growth for the Belgian economy. So, well, what we see is Belgian economy will stay afloat, but growth will be moderate. Eurozone will, in our assumption that there will be higher interest rates, there will be tightening of the ECB, but not that tight as in the US. You see that in the US, growth will see moderation because of the sanctions or the actions, I would say, of the Federal Reserve, while in Europe, things will get a bit slower done that way. So inflation will remain high in Belgium, more than 8%, and also the next year we will experience higher inflation than we knew before the pandemic. And I'm afraid that's something we will experience in the years to come. There are deep trends in society, such as greening the economy. It's not a free lunch. You will get things more expensive, energy transition, that kind of things, but also the longevity, the people, the baby boomers going to their pension schemes, and the tight labor market will make the situation as such that we will experience higher inflation in the years to come. Voila, that was it.
Thank you.
Thank you for your attention.
Thank you, Mrs. Goossens. It was so interesting. And I suggest we'll end up this webinar with a question that we received for you, and that you already spoke a little bit about, is to what extent has the automatic wage indexation deteriorated Belgium's competitive position in comparison to other EU countries in recent months? I don't know if the figures are already available or if you have an idea. You already.
Well, according to the National Bank of Belgium,
yeah.
We lost competitiveness last year of 3%, which is a high figure. Now, if you take historical average, we lose about 0.8% each year in the last years. And for the years to come, we will lose again competitiveness above this average. So this is not good.
No, absolutely not. Across our figures, things can get better. It's now time to stop right here. We are running out of time. I thank you all for your participation and presence at our webinar today. And I wish you a pleasant reading of these two publications and happy holidays. Have a good day. Bye-bye.